Hello everybody, Ian Maddox, Hitchcock Maddox Financial Partners, connecting with you on our Financial Planning Simplified video series. Over the years, this video has covered a lot of different subjects, sometimes things that are very in the forefront of the news that have to do with markets, economy. Sometimes we've talked about investing concepts. Other times we've talked about financial planning concepts that affect different generations, whether you're young, retired. We've talked about estate planning. We've covered a large range of subjects. We also have done educational series and sometimes even interviews with folks in the community, subject matter experts in certain areas that have to do with financial planning. Today, I want to do a brief introduction on a new series. This will be an educational series on what I'm calling the alternative universe. And when I say that, I don't mean some ethereal psychological disconnect from reality. I mean literally ways to invest, types of investments, asset classes that are different than what we typically think of being investments. So before I get into, you'll see this chart up here, this is helpful, I'll reference it here in a minute, but before we even jump into to describe what this series is going to cover, let's define what traditional asset classes are, and then we'll jump over to alternatives. So when we think of traditional asset classes, we're talking about stocks, bonds, and cash in a very simplistic sense. You can expand that a little bit. Different folks identify asset classes being traditional in different ways, but those are the three big ones: stocks, bonds, cash. You sometimes can talk about foreign currency and commodities and even real estate, but I'm going to lump a couple of those into alternatives. So that's what we're not going to talk about. We're not going to talk about stocks, we're not going to talk about bonds, we're not going to talk about cash, but we are going to talk about alternative investments. Why is this a subject that's important? Institutional investors have known about these things for a long time, and in fact, there's been a barrier to access. You simply had to have large sums of money, you had to make lots of money to even get into some of this stuff. And in some cases, that's still true, but there has been a democratization of investment strategy over the last decade in particular, and it's something that we try to bear into our client relationships and make available to clients when and where appropriate. And that's a very important disclosure that I should make here, is that as we go through this series, understand that all of these investment structures may or may not be appropriate for you. They may or may not even be accessible to you depending on your net worth, your income, the type of work you do. There are some regulatory hoops we have to jump through. But let's talk about these very quickly. We're going to address not every one of these in detail, but we will talk about hedge funds. We'll do a video, 4 or 5 minute video on hedge funds. We'll do a 4 or 5 minute video on private equity. Actually, this one will be a little bit longer because I'm going to connect these two dots, with private debt. So private, equity, debt, okay, both private, different sides of the capital stack. We won't talk much about that one. I may touch on it briefly when we're in this private equity phase. We will definitely talk about real estate, and we'll touch on partially real assets, specifically commodities, all right? Each one of these can have a benefit in certain clients' portfolios, in an investment strategy. It's something, again, that institutions have used for a long time. You may have lots of questions as to why as you're watching this video. One of the big ones, in a very simple sense, is this idea of correlation. So there's risk in investing, right? We know that. We know there's risk. There's all different types of risk, but let's just use the word risk generally. These have risks as well. They also have opportunities for return. What is unique about these is their correlation or lack of correlation to more traditional asset classes. So you may have the stock market doing this, okay, while private equity is doing this, or this. They may be completely disconnected or only partially connected. If you connect the dots, you can see how this might be beneficial. You can also see why, for example, an institutional investor like the pension fund for the state of California or the state of New York might like some assets that move differently than the overall market. So I think it's a beneficial subject to at least understand. Whether it's appropriate for you or not has to be determined between you and your financial professional, whoever you go to for advice, but it's something that we want to bring to the table for our viewers. So we're looking forward to connecting with you over the next 4 weeks on this subject and digging a little deeper. Until next time, Ian Maddox, HMFP.